Well done.
Thank you. All right, guys, so we're going to move on for our last session today, which is round 2 of the Pitch Slam. We're going to have another 7 folks come today and determine who will be crowned the Deal King of Best Ever Conference 10, the biggest conference that we've had so far in our production ability, not in headcount, but in our quality of audience, right? Because you guys are awesome. So today we're going to bring back our 6 judges in just a minute, and we're going to have 7 more awesome applicants. Like I said yesterday, we had 72 folks apply. We brought 13 here for the semifinalists, and tomorrow we're going to discover who our 5 finalists are for a second round. And you're going to hear from the judges why we picked these 5 and see if there's any unique one-off investment. And the winner, of course, will get a best ever advertising package for the next 12 months. Anybody here yesterday for the best ever Pitch Slam? All right, right on. What'd you guys think? 4 minutes, cool format? Cool format, right on. Any LPs watching? Yeah, you guys see something new that you hadn't seen before? Any GPs watching yesterday? Yeah, all right. What'd you guys think? Was this a difficult format? Difficult to present in 4 minutes? You learn anything for how to present your information? Yeah? All right. Well, yesterday we did the world trip of healthcare and retail, and we didn't get to any multifamily yesterday. We did ADUs. We did data center entitlement. Today, we're going to be going through multifamily, self-storage, litigation financing. We're going to have multifamily development, accounting firm OpCo acquisition, and industrial assets. So we're going to be all around the world, all around the country rather, and all around the different asset classes. Tons of diversity. So let's get started. Let's bring our 6 judges back from yesterday, our esteemed, notable individuals who are here to judge the crap out of these amazing people. All right. One more. There we go. All right. So we're running a little bit behind, guys. I'm going to run this fast, okay? But before we get started, Neil and Chris, I want to ask you guys one question. Whoever can answer first gets to go first. What was the one thing that you think you guys did when you won your year in the Best Ever Pitch Slam?
I think dressed well.
You dressed well. The tall effect, is that what it is?
I worked for both of us. And for me, I just think it was being concise.
Just
right?
being concise.
Just get your points out there, and then don't go on a ramble, and just do it.
All right, on.
Yeah.
You got anything for us, Neil?
Just structure and understand your time limits. Make sure that you stay on beat and have your conclusion before you run out of time.
So style and format over substance. All right, you guys hear that in the back? You guys ready in the back? All right. So this first gentleman has built a portfolio all by himself and is raising money for the very first time after having quite a bit of his own equity and his partner's equity in it for the first time to the Best Ever Conference. Please welcome Justin Spillers from Real Estate Alpha.
Imagine investing in an already successful portfolio of over 600 units. Imagine having over 30 million of equity protecting your investment. Imagine receiving fixed 12% annual returns with no tax until year 9. That's what we do at Real Estate Alpha. I'm Justin Spillers. My business partner Brandon and I created in 2016. We're an Ohio multifamily value add company. We're fully vertically integrated. We have about 50 team members. Brandon's a former engineer, owned a construction and a roofing company, sold that successfully to invest full-time with me. I went to Ohio State for undergrad and law school, practiced real estate law for 7 years. In 2016, left the practice, started investing with Brandon, bought our first property, grew it to over 700 apartments, all in Ohio. Pretty much self-funded today. Capital is our only constraint. We created a preferred equity fund last year. We have a 50-50 strategy where we bring half the capital, the fund brings half the capital for new acquisitions. Our entire fund is an evergreen open-ended fund, meaning you get exposure to our entire portfolio of all of our existing assets and future purchases. It's in that pref equity position, so you're number 2 in the capital stack right after the banks. You get a fixed 12% annual return. It's paid out from our global cash flow. This is not some aspirational or targeted IRR. It's a true fixed 12%. Our investors get 2 good options. You can reinvest that 12% every year for that pre-tax annual compounding at 12%. You double your money every 6 years. Or you can take the cash distribution every year on December 31st. We have a super unique tax strategy called return of capital tax distribution. So you pay no tax on that 12% until year 9. It's equivalent to a 15 to 19% annualized return. Best yet, it's liquid. After the first year, it's just 90 days notice, you can get some or all your capital back, so you invest in your own timeline. It avoids all the typical issues with syndications, skeptical IRR numbers, long-term lockups, third-party risk, low skin in the game. We change all that with our fund. This is the valuation of our investment portfolio of the last 10 years of me and Brennan investing together. In 2021, we went full cycle on about 200 units, reinvested the gain for that hockey stick growth the last couple of years. Left map is our scatter site of all the properties we own up and down the I-75 corridor in Ohio, mostly 8 large assets, 44 units to 200 units. The right side's our exit and refinances over the last couple of years. This is our capital stack. We have $72 million of value. This is using a very conservative cap rate in our real-time NOI. We have $3 million of cash. We only have $37 million of lender debt. We've only raised $4 million so far, so you'd invest in that same private capital tranche. We have $31 million of equity protecting your investment. I'd have to lose all $31 million before your first penny's at risk. This is a snapshot of our cash flow. We have $9.5 million of revenue, 3.7 expenses, 3.3 million debt service fund interest, net cash flow 2.5 million. Our sole focus is creating $70,000 of NOI as fast as we can. It equates to $1 million of new value. Real estate's a 15x multiple. The best way to do this is being vertically integrated. You decrease expenses, increase revenue. We do all of our own acquisitions, leasing, property management, maintenance, construction in-house. Construction is our secret sauce. Speed is our sole focus. By way of example, we do 210 hours on average in each turn. We have 95% SKU standardization. We do this exact same LVP floor, paint, trim, cabinet, countertop, bath fixtures, bolt-ons in every turn. We're trending for 7-day turns. I want to be at 5-day turns and ultimately 96-hour turns. This is the next property we're buying in Middleton, Ohio. Great off-market deal. $10.4 million purchase price, $2.7 million CapEx. It's 126 units. Our target NOI is a little under $1 million. Target refinance value is $15 million. Our CapEx, we plan to doing just 15 to 18 months with that speed focus. We're going to decrease expenses 10%, increase rents 30%. Cash to close $2.5 million. I'm bringing $1.25 million. The fund's going to bring the other half. Again, to recap, you're investing into a fund with 12% fixed annual returns, 90-day liquidity, no tax hit until year 9. We have 30% historical cash flow after debt service. We have $31 million of equity protecting your investment. I'd have to lose 43% of my value before your first penny's at risk. That's never happened in the history of multifamily in Ohio. No small or large company can outperform us in Western Ohio. We come to win.
All right, perfect 4 minutes.
Impressive.
Judges, questions?
The 31 million in equity, when did those properties get evaluated to come to that?
Real time. So we use our NOI as it sits today in our REO schedule, and then I use a conservative cap rate. I usually add 1 point to it. If it trades at 6.75, I use 7.75.
Got it. Thanks.
Do you get third-party appraisals or valuations done on those current properties to calculate, I assume, the NAV?
At purchase, we do an as-is and then an as-rehabbed. I have as-rehabbed appraisals that support the 72 million valuation.
Do you do one after you've completed the renovations and stabilized?
We do them at refi, yes.
Okay.
How are you going to decrease expenses by 10%?
Mostly the efficiencies. We put a ton of money on the CapEx, so our R&M is very low historically. That's the big one. The other one is just being hyper-focused on outsourcing as much to our virtual team members and using AI to automate a lot of our systems.
You said the last deal was off-market, the one in Middletown?
Yes.
How did you find it?
Yeah, so we are hyper-focused on buying off-market deals through brokers, which is a little bit of an oxymoron, but all I do is build broker relationships so that they know what our buy box is. I want to take every single deal on their desk, them call me up first, and put it under contract before they market it out to the masses.
Are these B class or C class?
Yep, great question. So we take C class and convert it to B class as fast as we can, typically out-of-state owners, mom and pop owners, ton of deferred maintenance, somebody who hasn't touched the property in 10 years. That's where we shine on our sweet spot.
What kind of vintage?
60s, 70s, 80s typically.
How long have you been taking investor capital?
For the first time in a pref equity fund since last year. We've done a little bit of private debt over the years though. In 10 years, we've never missed a payment.
Any boiler chiller?
So what was that?
Any boiler chiller properties?
Boilers? Half have boilers.
And chillers?
I'd say half of those have chillers, yeah, and half are window units.
And as an open-end fund, what are you looking to raise, and what's your minimum to get in?
Minimum is 50,000. We've raised 4 million. I plan to raise about 10 million over the next couple of years. That's how much capital I'd like to have in the ecosystem in addition to ours.
Can you explain your return of capital tax treatment?
Yeah, so our CPA, Ed Reitmeyer, he's the managing director at CBiz. He just invested with us too, which was very telling because he knows my numbers better than anyone. He developed the structure, so as long as there's no earnings and profits distributed to the investors, you can take a return of capital first treatment. So it's basically like you getting your capital back first, and then you realize all the gain on the back end. So in year 9, that's when you deplete your capital account just for tax purposes, and only then does it become taxable to you, and it's only taxed at long-term capital gains rate.
What is your fee structure?
So we don't charge disposition fees, acquisition fees, any of that junk you see in syndications. We have a flat 5% management fee. It's mostly through construction fees though, which is drawn out of our CapEx loans. So very small hit on the CapEx or the actual operating expenses. So most of it's pulled through that 5% fee on the construction management side.
How much do you put in per unit for renovations on average?
About $15,000.
So they're heavy value add deals.
Very heavy value.
And
Any reserves on the chiller and boilers? Those are the biggest fail components.
Sorry, what was that?
Reserves. Do you keep any reserves?
So we have $3 million of cash on hand. We try to keep at least $2 to $3 million available at all time for both CapEx, and so we have a full year's interest payment for all the private capital as well.
So you have a 90-day redemption period, right?
Yes.
Has any investors or any OPs redeemed their money so far?
Not yet.
And you feel confident you can redeem within 90 days?
Yeah, we have 5 levers to pull on. Me and Brandon have about $3 to $5 million liquid outside the fund. We have $3 million in the business. That's option 1. Option 2 is we could do a refinance. We could sell a property. We could just hoard cash and stop CapEx for 90 days, or we could go to our existing investor base.
All right, Justin Spillers, everyone.
Thank you.
Thank you very much, sir. All right, moving right along, we're going to take Guy Varble from Momentum Wealth Fund. We're talking self-storage. Come on out, Guy.
Where are we at? There we go. It's a door, people. It goes up and down. It's self-storage. There's a lock on the door. When people don't pay us, we put a lock on the door. They don't pay us again, we sell the stuff behind the lock on the door. No landlord-tenant requirements, no plumbing. It's very, very basic. Some of the doors you can drive right up to. Some of the doors you've got to walk into a building. But it's a door. There's a box of air, and it's a door. Turnover cost is minimal. Very, very, very straightforward and very simple. So where are we at here on this? There we go. My name is Guy Varble, along with my wife, Nikki Varble. We own Momentum Wealth Fund. We do self-storage. That's all we do. We love it. We're kind of geeky that way. It's something we do. Worst marketing slide ever, right? Past performance does not indicate future performance, and we're not selling a security. This is something you probably don't know, is that 2.7% of households use self-storage in the 80s, and today it's 12.6. So growth of population and growth of absorption in the country is a very big component, and we'll explain why. We have 3 specific types of customers. One is a transitionary customer. That's about 40% of our customer base, and that's the buying home and selling home. And this is a big deal. As interest rates drops and we see more people buying and selling home, that customer base increases. When it slowed down, that customer base slowed down, and we had to respond to that. We've got the business owner. Depending on how close we are to a downtown area, it's 15 to 25%. That's the clothing store who uses it for inventory rotation, and it's the plumber and electrician whose spouse says, get out of the garage, get a storage unit. And those people are very sticky. They don't really care too much. There's the emotionally attached customer who is the hoarder, who you might think of, but it's also, hey, me and my brother put mom into a facility because dad's passed. We're never selling her stuff till she passes. Those people will stay for decades, right? You got to know who your customer is. 3 things that's very unique about us. We are fanatically data-driven. We look at all of the data before we ever look at the price. How much does it cost? I don't know, because I don't care. If it's the wrong location, if it's a declining area and there's too much supply, I don't want it, because I want it for 5 to 10 or 15 years, and it's the wrong property, we won't buy it. We're very focused only on self-storage, and we have a very robust underwriting process where we underwrite at least 40% right now, 40% of all the deals that come on the market in the country. We pass on everything all the time. Our team generates about 25 deals a week that they're underwriting, and we're just mowing through it. I don't see them, Nikki doesn't see them, We love that. We're kind of geeky. We're very data-driven, but that's who we are. That's what we do. This is our team. This is just part of our team. Obviously, we've got general counsel, CPAs. We've got other people who help with our construction cycles and all of those types of things. But this is the people that we work with every day, every week. That's who we are. This is a very interesting heat map. We say we're doing 40% of underwrites on an annual basis, on a weekly basis. Right here, this is a heat map. This is where we're looking. We're looking everywhere. Right? There are some areas we don't like right now. It's the Gulf Coast and somewhat in Florida due to insurance volatility. Although, I'll tell everybody here, our insurance dropped 40% this year. So anybody who's got questions about that, we can make some introductions. It's been really great for self-storage. It's just the yellows is kind of a moderate amount of deals that we're underwriting. Red is a lot that we're underwriting, and blue is not so much. But I think the important part to understand is that we're looking with all of the brokers, right? We've got wholesalers out there who are finding and knocking on doors and looking for stuff, and then we also have the ability and do direct mail marketing. We do less direct mail marketing now than we did 3 years ago because there's more deals open on the market.
All right, Guy. Thank you so much. Round of applause for Guy. Questions from our judges?
So in the fund structure, or the 506E, I should say, how much are you looking to raise? What's your, what's the fees? Can you explain some of the structure?
Yeah, current pipeline, if we had $8 million today, we could move it all today in backlog and existing, right? So that's that. If we have more, like if we could get another 15 million after that, we'll just dial that 40% up to 85%, right? Pipeline is there, right? Next question, what was the other question?
Just the fees in the fund,
so we believe that a confused mind says no, so we either allocate or take fees up front, and it's anywhere from 2% to 5%, depending on the size of the deal, is what it is. Some of the deals we say, okay, we'll raise all of the fees, but we take some of them up front, and we take over the next 60 months a portion of those fees.
And what's the target return?
Like on the deal that we've got right now, it's 17%, with like a 2x equity multiple. Our goal is to double your money in 5 years or less. It's never taken us 5 years, so this year will probably be the first year that we get the whole 5 years. The last one we just bought, which is no longer open, but I like to talk a little bit about it. We bought it in December, $951,000 raise. Turns out it's a 3x equity multiple, 27% IRR. That one filled fast, right, because it was such a great deal.
Why is this year taking longer? Sorry.
Say that again?
Why is this year going to take longer to double people's money?
Because when we started 5 years ago, we had massive interest rate increases, right? So that slowed that. Then there was a whole shift. So COVID was awesome for self-storage, right? Went to 100% occupancy. All of our residential portfolio, which we no longer own, stopped paying rents. So for us, we've migrated completely out of residential, and we do all self-storage. Interest rates went up, and we're now start coming down. We're starting to see a little bit of cap rate compression. We're in alignment, but there was some absorption issues that we ran into in the last 18 months.
What could make these investments go poorly?
So we have two types of investments. One is self-storage. The one that we've got right now is boat and RV storage, right? There's two different types of customers, right? Self-storage, if we stay stagnant in our interest rates and people don't refinance, we're just going to stagnant in that one. Sorry. I got 3 minutes, right? No, we'll stay stagnant in that one stream. What's really interesting about self-storage is when people lose houses in volume, we go to 100% occupancy. We don't celebrate that. We just recognize the inherent downside risk mitigated factor. When people are making money and people are buying and selling houses and buying, a Sea-Doo in this one and a snowmobile in that one, we go to 100% occupancy. If we're ever at 100% occupancy, we aren't charging enough. We always build in occupancy of at least 7% vacancy and then upwards to 15% vacancy.
When you buy these properties, do you rebrand them? And what's your marketing like to bring in the tenants?
So sometimes we rebrand them, and sometimes we keep it. The name depends on the existing rates, the reviews that they have right on there. If they've got really good reviews and it's good community outreach, we'll keep that name. Most of the time we're buying it, and the biggest words on the sign are under new ownership, right? And so we change the name, we rebrand it. In self-storage, it's very localized, and we do very specific types of marketing. We like to develop 3 types of relationships: real estate agents, referrals, multifamily managers, referrals, and then we also like to have the elderly folks' homes as for referrals as well.
How many full cycles?
We sold 10 facilities in 2022.
Awesome. Another round of applause for Mr. Guy Varble. Appreciate you, sir. Thanks for coming. Momentum Wealth Fund, Mr. Guy Varble. We're going to take a quick hiatus from real estate and talk litigation financing. So please welcome Patrick Grimes from Passive Income Mastery.
I hope everybody's excited to be here today to talk about something new and unique. We're going to talk about legal funding, non-correlated returns in a completely different industry. I'm going to back this up just a little bit because I want to set the stage. First, this is not an offering to sell a security, just so you know. This is an educational webinar here. There we go. So I started off as an automation and robotics engineer, and through that, I started investing into real estate. I lost it all in 2009 and 10. So sure, I was successful after that at single family and apartment buildings, but I established a company called Passive Investing Mastery to do non-correlated alternative investments to build true security. So sure, we have debt, we have commercial acquisitions, but we have medical financing and legal financing. My partner in the legal space spent 15 years working with some of the most notable cases, spending about $500 million in initiating efforts to collect $25 billion in legal funding. Pretty incredible background. Now, why are $500 million going into legal funding? Well, about half of investors' portfolios, once they reach high net worth, is inside this alternative space. About half of that's in real estate. So where's the other half? Well, they're in lesser known alternative assets where you can get high risk adjusted returns and non-correlation. They want up and to the right. Medical and legal both follow that. They don't want, like my 2-year-old would say, squiggly. Steady growth. The outcomes of cases don't rise and fall with broader market volatility. So what is the case for litigation funding? People need to access justice. But when they sue people through the courts through litigation, it's very expensive. So they need attorneys to come along and work on contingency. These attorneys have put a lot of time and effort, but when they get near the end and later staged, they need help. But there's a lot in it. Why? Because these cases have significant settlements and judgments. Investors can participate in these and collect on those settlements. Now, it has to be done very carefully, through a lot of experience. Hyper-diversification is important. And late-staged, predictable outcomes is important. So, we're not taking a 50-50 flip here. There's things called mass torts with a lot of harmed people that are near settlement, and they need capital. There's things called single event cases with established law that are rinse and repeat. These have more predictable outcomes. And then you have hyper-diversification. We lend to law firms, established law firms, with very hyper-diversified cases, hundreds or thousands of individual lawsuits across lots of different types of cases. This gives us the types of returns that allow us to provide high growth potential in litigation finance investments that are non-correlated. Some examples of these cases are the sexual assault case, $4 billion settlement that we helped individuals get through the LA Juvenile Detention Center, our kids. Military base, water contamination causing horrific deaths at Camp Lejeune. We've helped over 1,800 military civilians and their families collect the settlements you see on the board ranging up to $450,000. Our fund projected returns are 1.9 to 2.4x, 20 to 35% internal rate of return. Our returns are a bit of a bell curve, so you don't have to wait until the end. The majority of the returns come in the second, third, and fourth year from thousands of lawsuits. 4,000 total in the fund today, 45 million estimated collateral value, and we're only at 10, 20, or 30% financed amount to that estimated collateral value, which is an incredibly low risk, high risk adjusted return. Not only do we allow for LP investors, but we have feeder fund availability that give enhanced economics and allow for capital allocators and sponsors like yourself to help your investors build more stability and non-correlated alternative investments.
All right, Mr. Grimes, round of applause. Thanks very much. All right, questions from our judges.
What would you say is the biggest risk?
Well, since 1920, not much has changed in the legal industry. In fact, big tobacco was the first third-party litigation funding, big win. So the biggest risk is, say, a new administration, Congress comes in and shakes up the industry. But the rule of law has been very consistent in this company, or in this country. It's one of the things we're most famous for worldwide, and it's very reliable.
What is your default rate, or I'm not sure if that's the right word, but default rate, delinquency, and have you lost principal?
Have not lost principal. Most of the investments are hyper-diversified, and we get a first position across a wide range of cases and thousands of lawsuits. Once we get our return, we're well out of the deal before the attorneys typically would have a case that didn't settle.
So who holds the paper in this case? Does your fund hold the paper?
So we have a first position in all of our cases with a financing agreement that specifically lists the individual contingency fee agreements we're collateralizing, as well as a guarantee on the law firms and the partners. However, we own that paper, we don't own the contingency fee agreement. The law firms and the client-attorney relationships is not sacrificed. They still get to provide access to justice and work to the best interest of their clients. That's why we're always late stage, because we know settlement agreements are already there or established law is predictable on what they typically settle for.
What amount of your staff are attorneys?
So we work with a bunch of partner attorneys, but my partner David Gooseman has been doing this for 15 years, literally going up against the whole street. So our finance attorney has originated over $1 billion in financing agreements, and we have law firm valuation specialists, which have evaluated over 100 law firm dockets. It's equivalent to an appraiser in real estate. So we are a finance company working with 15 years worth of relationships and attorney partners, but we're not attorneys.
Why do they need the cash if they've got a settlement agreement teed up?
This is a really good question, one of my favorite ones, because these contingency fee attorneys, they work very hard on their own cash because nobody's going to invest early, right? But towards the end, if they have a case in which they have 10 or 100 different claimants and they're nearing a settlement and they're already in settlement discussions, if they can get 500 or 1,000, then it's just going to increase the pie. More hard people get a settlement, the attorney makes more, and we make more. So oftentimes what they're looking for is to collateralize their near-term settlements to then invest it in marketing, because attorneys aren't just sitting around, especially at that stage, with $1 million or $2 million to go find another 100 or 500 different claimants to just bring more to the table. By the time the sexual assault case was settled, there was 4,000 people they found in the LA children, right? It took tens of millions of dollars to find all those.
How much of your own money are you putting in there?
We're about 5% of our AUM, pretty traditionally.
How big of a risk is litigation reform?
Since it's tough. I mean, there's been a lot of reform that killed us in multifamily. I'm partner in 4,000 units, and all of a sudden there was delinquency backlogs, right? So it's always there, but that's why my company structures non-correlated alternatives, right? There hasn't been reform since it became very established in 1920 here. None of us foresee major reform, and if there's reform, is Congress really going to go tell the sexual assault victims and the victims of military, our Marine bases, saying, hey, no, you don't get settlements for the harm that has been caused to you?
What type of rate is typically charged to the law firm that you charge the law firm?
This is a great question, because unlike real estate deals where you just have like a fixed collateral value, we actually have cascading waterfalls. So the majority of our agreements with the attorneys, we have a preferred return as a fund to our attorneys. So the majority of the agreements, we get all of our capital back before they get a penny. That's on all of their cases and all of their claimants. Then we have a return on that, which in some cases is a 26% IRR on top of that before they get anything. This is that high risk adjusted return. We get all of that before they get a penny. And then we have a waterfall. In some cases, we're getting 70% of the proceeds until a 2x, then 50% to a 3, and then 25% to a 4, and then we're out. And then they get all the upside. So we structure these to provide for tremendous downside protection for our fund and really significant upside.
One more round of applause for Patrick Grimes from PI Mastery. Thank you so much, sir. Thanks for explaining that to us. All right, we're gonna step back into the traditional. We're talking value-add multifamily, Ash Patel's favorite subject. You guys ready? Please welcome to the stage Levi Allen and Joe Rinderknecht from Cowboy Capital.
Gotta keep moving, don't stop.
What's up, guys? Good to see you both.
Keep moving, don't stop. Keep on doing what you're doing. Gotta keep moving, don't stop. Keep on doing what you're doing. Gotta keep moving.
All right, guys,
Don't
4 minutes
stop.
on the clock
Keep on
is
doing what
yours.
you're doing. Gotta keep moving.
All right, good afternoon, everybody. Joe Render Connect. This is my partner, Levi Allen. And these are our beautiful families. We're missing them today, but we're excited to present Cowboy Capital and our multifamily offerings.
A little bit about our backgrounds. Joe and I both grew up farming and ranching, and a lot of the values that were installed in us from a young age was your word is your bond, you do what you say you're gonna do. There's a lot of like handshake deals on the farm, and also we have background in property management and construction.
Yeah, like Levi said, we really value our relationships over everything, even over the transactions and the multifamily deals that we do. If you were to come to us and you're a new investor and ask us about a deal, we probably would tell you like, hey, let's get to know you, your needs, your wants, your goals, and then we would see if it's a good fit, right? As a good example is one of the most recent checks we raised was $2.5 million from an investor that we've been building a relationship with for 7 years, right? We like to have a lot of fun and really build those relationships. And as you can see in the last 18 months, we were able to raise $14 million with most of them being return investors. Our investors just can't get enough of us. They keep coming back and bringing their friends and family, mom and dad with them.
So a little bit about our track record. We've both been doing this for over a decade, 16 plus projects. I'm not gonna repeat all this, but on the next slide, you'll see kind of our bread and butter strategy has been buying in tertiary markets, mainly in the Mountain West and Texas, buying from long-term owners, mom and pop ran properties that are self-managed. We have great relationships with brokers. We get a lot of off-market deal flow. Here's one example, Orchard Lane Apartments, 6 miles north of here. Great sub-market, high-income area, just at the bottom of Eaglewood Golf Course. Bought it for just under $9 million, a little over $600 rent increase in 14 months. Appraisal came in at $14 million and a $1.7 million cash out refi.
Yeah, to add to our Mountain West presence, we bought this property, North Russell Apartments, from a 20-year owner. He built it in '98. We bought it from the original owner. We went in, implemented our business plan, our renovations, and we've nearly doubled the rents. We really love the Missoula market. We bought it for $6.8 million, and we got a broker opinion value, or BOV, from Northmark at $11.8 to $12 million.
Hilton Street Apartments, same story here, just buying it from a long-term owner. Once again, we closed 4 days before their maturity date, so they had a 10-year term loan. We were able to negotiate a great basis. Same story, being able to push rents tremendously. And our deal that we're about to present is, if you want to take a guess, long-term owner, self-managed, no marketing since they've owned it since 2008. Mismanaged, $58,000 per unit. They're 1, 2, 3, and 4 bedroom units. This is in San Marcos, Texas. We just bought a 292 unit project last October, 2 miles from up the road from here, so we know the market well. We have 4 unbiased third-party property management budgets that show a year 3 NOI of $740 to $820. So that's about $12 million valuation at a 6.5 cap, which is about double what we're purchasing it for.
Yeah, and one thing that we really like about this property is it's like 2 miles away from Texas State University. We're surrounded by student housing, and this is one of the only market rate properties in the general area right there.
Joe and Levi. Questions from our judges. Ash, you can go first if you want.
Let's go, Ash.
Are all of your properties third-party management?
They are.
Okay.
Yep.
How much you guys looking to raise?
We're raising $2.7 million, and we've already raised $2.2 with 4 investors.
What's your targeted return?
So
18 to 20 IRR, little over 10 average cash on cash.
Have you guys gone full cycle on how many deals?
I missed that on a slide. Yeah, 7 full cycle deals and then 3 refis additionally.
Is there any boots on the ground in San Marcos?
Yes.
yeah, we have a construction manager who does, he manages all of our construction on our 292 unit, and he'll be a partner with us on this deal.
How big is your in-house team?
The in-house team in San Marcos.
No, for Cowboy Capital.
So right now it's Levi and I and a couple other people, accounting and some support. But we're a pretty small team, but we have a really good, trustworthy third-party team at all of our properties, and especially this one.
So why multifamily?
Why not multifamily? Everyone else is not. Well, so yeah, what's been the main theme here? Seems like everyone is buying triple net, but yeah, I guess we're kind of trying to not do what everyone else is doing, and we feel like now, I don't know if you saw Jay Smith's, Jay Scott's presentation, but yeah, we're big believers in that. And really with the business plan that we have, it doesn't really matter what the market is doing exactly, because we can have a lot of arbitrage when we're buying from this type of profile of owner and changing the P&L regardless of what market rents do and stuff.
A couple questions. One, what type of financing?
This is with Cadence Bank, 5-year fixed, 6.4 rate, 2 years IO, 75% leverage, no prepayment penalty. These smaller deals we typically do local banks. Usually they're the most aggressive in each market, and we get a little bit longer term on our runway. It is full recourse, but only we're signing.
And do you plan, you said it was by Texas State, do you plan on having student housing drive your tenant?
Go ahead.
There's only about 10% concentration now, because they're all like 15 to 20-year residents that have lived there forever. We are going to invite more student, but we're not going to run it as student housing. We'll probably get to maybe 30%. That's kind of the Fannie Freddie threshold for your best terms.
What kind of vintage are these properties?
The vintage, there's 2 properties, 83 and 97.
Did you buy any properties in the 2020, 21, 22? And if so, how are they performing, and what headwinds do you have?
Yeah, I pivoted. So I was buying value add from 2017 to 2019, 2020, 21, 22, and 23. I bought 3 Class A longer term hold deals, and the cash flow is down, but they're doing okay.
Yeah, and in 21 to 24, I had a deal go sideways, but we were able to get a full return of capital. And so that was the only deal that I really worked on in that time, because I was so focused on making sure my investors got their capital back.
What's your co-invest and fee structure like?
Yeah, so we usually will invest between 10 and 20%. Like on the Missoula deal, Levi and I we put in 650. The 292 unit, we have our GP team has over $1 million. And our fee structure is pretty typical. We have a 3% acquisition and 2% asset management fee. No dispo, no hurdles or IRR hurdles or anything like that.
What's your waterfall?
So it really, on this one, we're doing a 85 for Class A, $1 million plus.
You can finish.
For Class A, $1 million plus, 85-15, and then 250 plus is Class B. That is a 80-20, and then for 100K plus is 75-50. 75-25, sorry.
All right, Joe and Levi, everyone. Cowboy Capital.
Keep on doing what you're doing.
We're going to have to call these guys the basis boys. We got your deal 60 cents on the dollar. All righty. Who all here thinks malls are dead? Nobody wants to be wrong, huh? Nobody wants to be wrong. Well, to prove you wrong is Andy Weiner here from Rockstep Capital. Welcome, Andy.
Rockstep Capital is a shopping center investment company focused on hometowns throughout the United States. We built or acquired over 10 million square feet of shopping centers. Our IRR since inception 27 years ago is over 30%. What is a hometown? That's where we invest. Markets under $1 million, over 100,000, great quality of life, low cost of living, essential drivers that create population growth. What are the success factors in hometowns? We do something nobody else in the country does. We go out and we get local business leaders to be part of our LP investing. It helps with property taxes, incentives, entitlements, leasings, influence. We also get local lenders, community bank lender, market rate, no prepayment penalty, good news lending capabilities. Why retail? Two reasons. One, no more retail is being built. You can see historically low. Therefore, favorable supply-demand dynamics. Look at all these companies that are expanding. Aldi, 225 stores a year. Five Below, 150 stores a year. TJ Maxx, 130 stores a year. On and on and on. Dozens of companies are growing into an inventory that's not growing. Favorable supply-demand dynamics. Second, we've got lots of positive leverage. Cap rate higher than your interest rate. So our targeted deal, Greenwood Mall in Bowling Green, Kentucky, 15.5 cap is the cap rate. Our debt is at 6.5%. Tremendous positive leverage. Why shopping malls? Because they're cheap, great cash flow, well located, lots of optionality. Our thesis: great mall, location, Main at Main, in front of Target, in front of Walmart, no, very little vacancy in the market, very little vacancy in the asset. Bowling Green, Kentucky, fastest growing county in the state of Kentucky, great manufacturing, Western Kentucky State University, lots of tourism. Property overview: 750,000 square feet. We're buying it at $50 a square foot to the building. That's 20% of replacement cost, not too far from land value. Great tenant mix. We've got companies like Bath & Body that are doing $5 million of business in 3,500 feet. Great leasing momentum, and our financing structure, our debt service coverage, because we're buying this at a 15.5 cap, is 3.5 times debt service coverage. Very, very safe. 28% debt yield. We return, after our 8 pref, 30% of capital during our 5 years without a refi, and we're amortizing the debt. Targeted investor IRR is a 16.2% with lots of cash flow, and our exit cap rate on paper is 15%. If, holy cow, we end up at 13%, it's off the chart in terms of our exit. So at Rockstep, we don't like sex, okay? Not talking about me, I'm talking about Rockstep. And what we really like is non-sexy properties that provide extremely boring cash flow.
All right. Andy Weiner, everyone. First flex I've seen with a 3.5 debt service coverage ratio. That's a flex. All right, questions from the judges.
How many malls have you all bought and sold?
So we own 14 malls right now. We have sold 2. We're in the process of selling several others, and we plan to buy 2 or 3 a year. We look at every single mall for sale.
Those 2 that you sold, when did you sell them and how'd they go?
One was at a 15 IRR, 3x. The other one was a 24.5% IRR.
What real work are you doing in these malls after acquisition?
There's 3. For this mall, it is keep it leased and be prepared in case you have the opportunity to get back one of the anchors. So in this space, your downside is your upside. If you're able to get back Belks, which is one of the anchors, there's 2 or 3 different options that we've developed with some of the community leaders and our local investors. We do have local investors lined up, the heavy hitters, the key business leaders in Bowling Green.
How do you develop those relationships with the local key LPs? Because that sounds very difficult.
That's what we do. So what we'll do in every market, we'll go and meet the key business leaders. That's part of our due diligence. You, business leader, what do you think about that asset? What do you think about this community? What's happening to population growth? We're targeting a, let's call it a high teens IRR. Do you want to be part of this investment? And many of them will say yes. They're often very wealthy, and very frankly, they want to buy it on the exit.
So are you meeting them through like the Chamber of Commerce, or how
It's
are you
every way.
sourcing
So
them?
it's Chamber of Commerce, it's through bank conversations, it's through our own network. It's basically networking, and it's done very fast. And then you'll do visits in the market, you'll do a pitch either individually or jointly, And if you don't get investors to believe in the asset, to believe in Rockstep, to believe in the community, you walk the deal. I mean, it works both ways. It's part of your due diligence, and it's also part of the method to reduce risk in the asset.
So I haven't been to a mall in a long time. I just go to Amazon and just buy stuff and it's delivered. So what's
You're a terrible person if you
yeah, exactly for this.
Terrible.
But what characteristics are you looking for to ensure that that the tenants stay intact?
So look, we have people from Blackstone, Brookfield, CBL, the big REITs who work at our company, and so we really understand how a mall works. And the most important thing is, if you're buying a mall at 13 or 15 or 18 cap, is can you develop with conviction that NOI is stable at some level? So in other words, NOI is 5.2 million according to the OM. We'll go tenant by tenant and we'll right size each tenant, kick some of them out, and really the NOI is 4.7, and we'll buy it at a 15 or 16 cap at our NOI, where we have conviction that NOI is stable. And so at a minimum, if you're buying something at 15 cap with 6.5% interest rate, all you have to do is keep NOI stable. If you can improve it, which we do, that's even better.
What is the current occupancy of this?
What's that?
What's the current occupancy of
It's about 90%.
How do you handle leasing?
We do it internally. We've got we're vertically integrated. We've got 3 leasing directors. We've got an extremely strong culture of 26 rock steps or rules that hopefully motivate some great people to stay with us.
It sounds like these are very hands-on projects.
They are very hands-on.
How many assets do you manage at any given time?
We currently manage 24. We got about 100 employees.
How's the lease burnout looking for the next 5 years?
How's the lease what?
Burnout.
So the WALT on it is generally in an older asset. It's pretty short. It's probably 3 to 4 years on assets like this. Right now,
you can finish.
Right now, retail's in fashion, so you actually have the ability to raise rents.
All right, Andy Weiner, everyone, from Rockstep Capital. Excuse me, folks. Thank you so much. Appreciate you. All right, we got 2 more here, and then we're gonna wrap up our day, let you get on to the next thing. But before we do that, we are gonna take another step out of commercial real estate. We're gonna talk OpCo acquisitions from everybody's favorite service providers, CPA roll-ups around the country. Please welcome back to the best ever conference, Reed Goosens. What's up, man?
All right, let's get into it. 4 minutes. Hey, my name is Reed Goosens. I'm the co-founder of Accounting First Group, and we're building a recession-resilient investment platform by acquiring cash-flowing CPA firms with a clear exit to private equity. Some of you may know me from RSM Property Group, where we've spent over a decade building $1 billion worth of portfolios. And what we've learned in real estate is that it doesn't come from timing the market. It comes from buying fragmented, inefficient assets and institutionalizing them. And accounting firms are those business service versions of multifamily. So think recurring revenue instead of rent, sticky clients instead of tenants, fragmented ownership, and meaningful expansion once you scale. Now, we're focusing on intentionally buying CPA firms below, I probably should be doing my clicker, shouldn't I? Sorry about that. Below $3 million, because that is where it's too small for institutions. Private equity doesn't touch them, competition is limited, and the going in multiples are very low with highly profitable founder-led businesses with decade-long client relationships. A bit of history, there's 85,000 accounting firms across the United States, and 60% of them are with owners with over 50 years of age with no succession planning. So it's creating a very opportune time market right now in the market before institutionalizing has come to play, where there's motivated sellers at favorable terms. Now, we are raising a $15 million fund to buy between 10 to 12 of these firms at roughly 4 to 6 multiples and scaling them up with arbitrage of between 10 to 12 multiples. And a key part of how we're managing risk is through the capital stack itself. We've got roughly 40% bank debt, 20% seller carry notes, 20% seller carry rollover from their equity. So it keeps leverage conservative. Sellers are invested post-closing and incentives are aligned. Now, the exit math is clear. As mentioned, no one wants to buy between 2 and 3 EBITDA multiple firms, so our goal is to serve them up a feast to private equity, a nationwide platform doing $10 to $12 million of EBITDA with diversified revenue, professional management, and predictable cash flow, which is what people are going to want to pay up for. Now, in terms of how we unlock value, this isn't just a roll-up, it's a transformation. We modernize systems, the adoption of AI is massive in the CPA space, professional management and services through cross-selling and advisory. Now, there's also a flywheel here with RSN Property Group. We can take some of the clients and refer them over to our multifamily side. In terms of fund returns, we're going to give a 12% pref plus profit split on the back end, depending on how much you invest, and we're targeting a 25% IRR over 5 years. Now, why are we, should we go back one? Why are we here at the Best Ever Conference? Well, it's because AFG is a PIG, it's a passive income generator. We all know commercial real estate produces great passive losses. Combine that with a heavily cash flowing asset like AFG, it's an option for you guys. This is not a replacement, it's a complement. Now, we're already acquiring firms. We've already purchased 2 firms, one in New Jersey, one in LA. Both firms are over 20 years in existence. Both of them have over 32% EBITDA multiples with a lot of seller carry rollover. And the final close is, if you like accounting firms, it's institutional grade investing in a space that is still priced like Wall Street. We're taking a proven value-add playbook and applying it in a recession-resilient industry like CPAs and before the private equity comes in. So if you're interested in this strategy of building durable cash flow, intelligent scale, and clear paths to private equity, please scan the QR code on the screen. It'll take you directly to the investment platform.
All right, Reed Goosens, everyone. Appreciate you, man. All right. Questions from our judges.
Reed, I know you for multifamily. How are you doing both this and RSN? What's the partnership and team like? Because split focus is a concern to me.
Yeah, no, it's a good question, right? So we are partnered up with a small family office. So the 2 firms that we've already bought is through a family office who's running the day-to-day. They're an Australian family office. We've known them for 12 years. They were the first KP on my deal back in 2014 when I first got started. Multifamily is not a distraction for us. We are raising funds for this capital. So, I think of it like a shiny motorcycle. We have got the motorcycle up and running through their funds, and we're going to replace their funds over the next 12 to 18 months.
So you're rolling up a bunch of small CPAs to aggregate 10 million plus of EBITDA, is that right?
Correct.
Would your buyer honor like a higher EBITDA multiple in that scenario, or are they going to keep it lower?
Well, the thing is, they want, I didn't have a lovely pie chart, but as you go up the capital stack in EBITDA, so every sort of $5 million to $10 million of EBITDA, you get higher multiples upon exit. That's the arbitrage. So based on our research, we're thinking that we're buying between, I said, 4 to 6 EBITDAs going in. We think on conservatively 10 to 12 on the exit.
So I would agree with that if it was a single firm, but the fact that you're aggregating a lot of small firms with higher key man risk, higher fall apart risk, et cetera, I think there's a lot more risk on that, such that your buyer may not honor that level of EBITDA multiple.
Sure, and that's why we're going to bring in a C-suite professional management, right? We're not the idea is that these firms aren't, they're handling the day-to-day, they're in their own silo, they have their own identity and brand, but a layering on top of that is the AFG C-suite, which is going to be a CEO, which we're already in place, a CFO, plus, the rest of the infrastructure.
So you're putting them all under a singular brand?
Correct.
Got it, okay.
How are you generating your pipeline? Where are all these firms coming from?
These firms are coming from both broker relationships, but also direct Facebook ads. It's surprising how many people on Facebook, CPA firms on Facebook, want to sell today.
And you mentioned there are 85,000 accounting firms. Out of that, how many have EBITDA below 3 million that you're targeting?
That's a good question. I'll have to go. I'll go back to you on that. I don't know. I don't know the exact, but it's a small percentage. I would say more than 50%.
Yeah.
Any geographical concentration?
So,
any particular geography?
No, we want to actually be nationwide because the key part of this is that clients aren't the knife fight, it's talent, right? And we want to have a constant pipeline of talent coming through, and having a nationwide platform means that we can offer internships to people coming out of CPA school, which is limited, plus having them grow across a potentially nationwide platform.
The average age of a CPA right now is up there in age. They're not easy to backfill. Is that a significant risk?
100% it is. Why we also think AI is a massive force multiplier in this space. We have already acquired new staff at both firms, so we're already out there, increasing the staff count, replacing, certain levels, particularly on the, I would call it like the accounting manager level is the hardest one to do, but a lot of the back-end stuff is going to be replaced by AI, and that's where we think they become more efficient with the staff they already have in place.
Out of the 15, how much have you raised?
We've done $2 million today.
And do you have anybody who is a CPA on the team?
Yes, our CFO is a CPA. She's been in the business for over 20 years.
Any regulatory risk that you see?
What's that?
Any regulatory risk?
Any
regulatory
risk? We have out-of-station work that needs to be you have to partner up in the terms of the way you structure that, but we've already been able to manage around that.
What's your competitive advantage for recruiting the new CPAs? 'Cause I've talked to many CPA firms, and they have a very hard time, and they lose it often to other people. How do you win them?
Yeah, very good right now. So we're going through that sort of teething process as we speak. We just mentioned that we've just brought on a couple of new key clients, key staff members.
You can finish.
And yeah, the whole goal is to get that nationwide platform. Right now, this current staff are to the individual CPA firms, so they're local. But as we start to expand and we start to bring the services more back of house and we start to expand overseas in terms of AI and the automation, that's how we're going to be able to do more with less.
Awesome. Reed Goosens, everyone. Appreciate you, sir. Thanks for being here. All right, we're going to finish the day out with our one and only industrial play on this Pitch Slam Best Ever Conference 10. So please welcome to the Best Ever Conference for the first time, Brian Kerr from Snowball Development. Welcome from New York City, sir.
Thank you so much. Thanks for sticking around. I'm going to try and punch through this really quickly to give time for questions. So I'm the founder of Snowball Developments. I started the company in 2021. I go to the next slide. Sorry, I'm the one who has to cue this up. Sorry. There we are. A little disclaimer. Sorry, I'm going the wrong way. Did I just lose my entire presentation?
No, we're good to go. Let's reset to 4 minutes, please. Forward, back, forward, back, forward, back.
Forward, back. Okay. So our company now has been in business since 2021. We've done 15 acquisitions over the last 4 years, all clustered in the Northeast tri-state region of New York region. The main reason why we're there is I'm local in Brooklyn. I can get to every single one of these properties in 2 hours and back home by bedtime every day. We are in these markets, very active, underwriting every deal that's there. We have a 5-person team, really focused on asset management, the most key components of real estate. We outsource our property management to Lincoln Property Company and Greek Real Estate Development. These 2 assets I'm talking to you about are in Connecticut on the I-91 corridor. It's the main spine that leads from the shoreline up into western Massachusetts. There are really only 5 main trucking routes across Connecticut, so all industrial absorption, expansion will take place on these key corridors. So we're very zoomed in on these corridors where demand is being funneled as tenants are being priced out of the greater Boston area and priced out of the greater New York City area. This deal is a 2-building package. We sourced it off market. It's 100% leased with a weighted average lease term of just over 5 years. 38% below market rents in place is our downside protection. We like to set ourselves up with deals where it's heads I win, tails I win if they renew or not. But we believe these tenants will want to renew with us because they are deeply entrenched in these buildings with limited options for any sort of relocation. Our capital stack is, reasonably leveraged at 63%, and we're generating LP returns of just under 16% and a 2.6 equity multiple over a 7-year holding period. The tenancy is, there's 3 main tenants. There's a small one that's rolling this first year. The broker's already reached out to us for a renewal at that property. Then you have Walgreens, who is a tenant in our 770 Marshall Phelps building. They have a 3-year fixed rate renewal option below market. As I said, we'd be delighted if they don't exercise that, but we think they will. The final tenant is Industrial Flow Systems. They have proprietary valve production technology. They also have a fixed renewal option in 2033, and so we believe that they would exercise that. So there's a couple options for us to exit. Either Walgreens exits in 2029, and we're able to reset to market, create value, exit at that stage, or they renew, we get at them 3 years later, plus the combined renewal of the larger tenant. That's our 7-year exit plan. We've got CMBS debt ready to go on this deal. We believe that we're going to rate lock around 6.5%, creating positive leverage at closing. And then the chart on the right is what we really like on every deal, where the rents are growing faster than our contract rent, always providing an embedded upside opportunity for us or for a future buyer. Our cap operating projection, we start out at just under a 7 cap. 6.4 yield on cost, growing to a 10.5% yield on cost by year 8. We actually believe that we can exceed this revenue by adding additional revenue streams at the property, but we haven't included in our base case underwriting. We run our sensitivity analysis. We run it a couple different ways. You know, if we're going to run into extra capex, if we're going to run into a higher interest rate at closing, exit cap rates as well. We feel very comfortable that we're going to end up in the mid-teens on this deal. That's why we like these core plus opportunities that have value add return characteristics. Any questions? Happy to answer them.
All right, and I don't know if I missed it, but I think one thing that's interesting about you, since we have the extra 20 seconds, I'm going to throw it in there, is you worked at the New York City EDC for several years before you started Snowball, right?
Correct. So part of my training was a 15-year brokerage career at CBRE in Montreal. I did about $4 billion of transactions, Canadian, so not as much. And then I spent 3 years at the New York City Economic Development Corporation. One of our values that we can bring to the table is walking into land use council meetings and being a former bureaucrat. We can talk about community engagement in a much more concerted way.
Awesome. Brian Kerr, everyone.
Thank you.
Questions from the judges?
So you mentioned you may have a 7-year business plan on this asset, but your debt's at a 5-year term. What happens if this goes to 7 years and that debt, what do you do with the debt?
So we believe that we'll be able to refinance that debt positively based off of where the contractual cash flow is growing to, plus additional income streams we can do. If we have modeled out a cash out refi in year 5, that would generate about $1.5 million of cash out proceeds at that point in time.
Do you have any extension rights on this loan?
There would be extension rights to be for a year, so I think that we would ultimately have to replace that loan if we had to go the distance.
In the event that some of those tenants did not renew, can you talk us through a little bit about your leasing process and the assumptions underneath it?
Yeah, so we're a very pro-broker formula. We'll handle renewals ourselves because no one understands the business plan better than us. But the moment that we have vacancy, then we are working with the sharpshooter in that market. Connecticut's not a very large market. It's an emerging industrial market. It's kind of like Nashville 8-9 years ago. No one went to Nashville for industrial 9 years ago, and now everyone's there. But there's only 4 brokers really per submarket that really carry most of the business, and it's the big 4 big brokerage houses.
Ryan, the retail pharmacy model is in trouble. Rite Aid went bankrupt. Walgreens has lost a significant amount of its market cap. Are you concerned that Walgreens is your tenant?
I would love it if they leave. They occupy 50,000 square feet mid-bay in a market that is ripping right now. The Indus portfolio just transacted at $131 a per square foot, a 5.75 cap. This building's right next door. There are tenants that are going to be pushed out of that portfolio as LBA is going to have to ramp up rents. So I'd love to be sitting there with the catcher's mitt with that building.
Good answer.
That answers your question.
What else we got, guys?
But honestly, if Walgreens stays, they're great too. They're a great tenant. Everyone, they've used this facility specifically for returns. It's a supplemental facility to an 800,000 square foot facility by the airport. So they need this space. They don't even rack it. It's literally unpalleted bags of, I don't know, there's Squishmallows there the last time I was there, and I asked if I could bring one home for my daughter.
Have you gone, you started your firm in 2021?
Correct.
Have you gone full cycle on any deals?
We did on our first acquisition. We sold it to a user last year. That was not the business plan. But we did de-encumber the building. We found a user to buy the property, 28% IRR, 3 years and change holding period. I would say the blessing and the curse of being starting our company at COVID, or just during COVID, is that we didn't YOLO into any crazy transactions in 21 and 22 that I now regret. The curse is that it's tough to exit. Exit cap rates are higher. It's still not it's not a great investment sales market. It's a great time to be a buyer, which is what we've been doing consistently through the downturn.
Are any of your current assets, while it's a bad time to sell, how are they performing now in terms of like cash flow pro forma?
They're all trending well ahead of NOI. I mean, that's been the beautiful thing about COVID for industrial rents is that rent growth has well surpassed any of our modeled rents when we bought them.
What year is this asset?
Sorry?
When was this building built?
There's 2 buildings. One was built in 1980, which is the New Haven asset, renovated in 2021 by this user who then executed a sale leaseback with our seller. The other building, Marshall Phelps, was a 1989 facility, 26-foot clear, still very modern and functional for a mid-bay asset.
What's your co-invest?
Our co-invest is 15%. We have a family office as our co-GP on the deal, and we're a quarter and they're 3/4 of it.
So the partners are a quarter of that 15%. The family office is the other 3/4.
Correct. Yeah.
Well, all right, guys. One more round of applause for Brian. Thank you so much.
Thank you so much.
All right. All right, guys, I'm going to ask our judges to debure off stage and go confer as our final 5 selections. Thank you guys so much. We're running 10 minutes behind, so if you are trying to get to speed networking, don't worry, it hasn't begun yet, but I am going to cut us off here. We're going to open up these air walls and get speed network going. You can head over to the LPGP speed networking if you're signed up for it, right behind me here. And if not, I will see you in the morning where we find out who is the deal king of Best Ever Conference 10. Enjoy the night, folks.